Hi, let's say you are in the fortunate situation that you have money invested or you're thinking about investing some of your money, and the uncertainty that we have in the markets is simply scaring you. I mean, honestly, the stock market has been a disaster. Gold prices are through the roof. You probably don't want to invest in that anymore. And crypto is still a mystery to me. I still don't understand completely how blockchain works. So if you're really looking for investment, but you cannot find anything that sounds good, safe, and reliable to you, well, I'm sure you have, if not you should, thought about investing in real estate. And I'm focusing a little bit more today on real estate investing for rental income properties. My name is Jürgen Herzog. I'm with Better Homes and Gardens Real Estate Best Life. I'm a real estate broker for almost 3 decades, and I dealt with a lot of clients who bought rental income properties over the years. I invested in those myself, and I found it's actually a very sound investment when done right, and your horizon is more long-term. So today I would like to go over what to watch out for when buying rental income properties, what the process is, what the differences are to buying your own personal home, for example, and all the pros and benefits you have when investing in real estate, and some of the risks you take as well. So let's dive in. First of all, financing real estate, non-owner occupied rental property is a little tougher to do than buying your own home. If you buy your own home, you can get away with a 3.5% down payment. If you're a veteran, you might even get 0% down payment. That does not work for income properties. A lender will require you to put down at least 20%, probably 25% as a down payment, and the interest rate will be higher. And non-owner occupied mortgages tend to be 0.5% to 1% higher than if you buy your personal residence. Okay, let's say you found the perfect lender. And by the way, if you need help finding a lender, reach out to me or my business partner. We're happy to hook you up for the right lender to find you the right mortgage. But if you found your lender and you're pre-qualified, you're ready to go to buy your investment property, well, how do you determine which one is a good investment and which one is a bad investment? Because there's some bad ones out there and there's some great ones out there. And one thing initially you should do, especially when you do just online browsing and the only information you have is maybe price and the rent income, the gross rent per year, well, you could use the GRM, and that's a gross rent multiplier. And the formula is very simple. Basically, you take the sales price, or the price you're going to buy it for, divided by your gross rent income. So let's say you have a house, you buy it for $500,000, your gross rent is $50,000, you divide the 500 by the 50K, you come up with 10. That's your gross rent multiplier. And with the GRM, the lower, the better. Let's say your rent income is 100K, well, that would bring up the GRM to 5. So it's lower, a lot lower than initial 10. And if you compare properties like this, you can filter out the really bad ones and focus a little bit more on the better ones. But I think there's another formula that works better for me personally when I buy rental properties or go over it with my clients, is the ROI, the return on your investment. Because ultimately you want to know what percentage you get on your invested money so you can compare it to the stock market or to gold or whatever you have. You have to find out what your annual net income is. So that would be the gross rent minus repairs, maintenance, utilities and such. And you also have to figure out what your cash investment was. That would be your down payment if you finance it, the whole amount if it's an all cash deal, plus any closing cost. And once you divide that annual net income by your cash, you come up with a percentage you're actually earning on that money you invested. So here's a quick example. You bought a house for $500,000. You came in with $100,000 cash, and let's say there were no closing costs to keep the number simple. So you have $100,000 of your own money invested. Then you take the annual net income, let's say the $10,000 in this example, divided by the $100,000 that you invested, you come up with 10%, and that is your return on your investment. You're getting 10% on that money invested back. And that is actually a decent investment. So do that for every property you're buying and find the best one that works for you. And please don't be an emotional investor. I see that a lot. I work here on the Central Coast. We have some gorgeous, fantastic, beautiful, and kind of cutesy and charming communities with a high rent. But we also have some communities that are maybe not that charming or appealing to a potential buyer, but in which the homes are a lot cheaper. The rents are almost as high as in the more appealing communities. So your return on your investment is actually a lot higher in a lot of communities that might not be as fancified as others. So if you're an investor, you don't live in the property. And if you think, well, maybe later on I want to move into it, well, still buy the better investment, sell it later on and buy something with the money you made in the more preferred community. It's a better and sound way to invest your money. And there's another risk factor you should watch out for when you're buying rental property, and it is rent control. It's popping up everywhere. Communities trying to reduce the amount you can increase rent or tighten the restrictions you have on, let's say, evicting your tenants and finding a better tenant. And one big change we had here in California is the TPA, which is the Tenant Protection Act that was passed. It limits how much you actually can increase your rent on your investment property, which again has an impact on your return. And also it makes it a lot harder for you to evict tenants that might not be working for you. That said, some properties are exempt from that rule here in California. And one of them is single-family dwellings, condominiums, and there's a few other exceptions, if they're not owned by a corporation or an LLC. So if you invest, you have to focus on what you're buying. In the past, very often investors bought duplexes and triplexes. That is not exempt from the TPA, but individual houses are. Instead of a triplex, buy 2 homes or 3 homes or 3 condos individually, and you are exempt from those really tight restrictions that really have a big impact on your income. Also, there are a few more things you should calculate in, maybe in your ROI formula or just in general. A house is an investment that needs maintenance. So every 20, 30 years, you might have to put a new roof on, you might have to replace a few windows. Don't forget that in your calculation. And also, if you don't want to deal with your tenants directly, it's an out-of-area property or investment, you need property management. And they easily charge you 8 to 10% of your gross income. And very often when the tenant moves out and another tenant moves in, they charge you an extra half to full month rent too. So keep that in mind when picking your investment property. By the way, if you have any questions regarding potential real estate investments, or you want to know more about the TPA, or what areas to invest here on the Central Coast or elsewhere, feel free to reach out to us. Even if it's just a question, we like to give advice and help you out. So, why would you invest with all those risks, and you have to maintain a property, you might have a manager to handle it? Well, it is a good investment for a few reasons. And one of the biggest ones for me that I always find stunning is actually the appreciation. In an average, I would say here in California, you're looking 5 to 7, some areas even 10% annual appreciation of value. And I want to describe that a little bit in an example. You bought this home for $500,000. Your cash investment is $100,000. You're having your income, your ROI on that $100,000, but on top of that, the home value, let's say it goes up 10% just to keep the numbers a little easier. In 10 years, the 500,000 home will be worth $1 million. Your investment was 100,000. So in 10 years, you made $900,000 with an investment of only 100,000. And that is an incredible return if you think about it. And then there is the book depreciation. Yes, I just said your value appreciated, and that's true. But the IRS sees it a little different. They think a building loses value over time, and they let you, there's some other ways to calculate your depreciation, but the most common one is you divide the building value, so you have to take the land value out, by 27.5, because they think by that time your house is worthless, at least the book value, and you can write that off against your rental income, which is a great tax benefit. Quick example regarding the depreciation I just mentioned. Let's say you bought this house for $500,000. $100,000 you estimate is the land value that cannot be depreciated, but $400,000 is the building. Well, if you divide the $400,000 by 27.5 years, means per year you could offset your rent income tax-wise by about $14,545, which is a great tax benefit. Now, one thing I have to tell you, I'm a real estate broker. I am not allowed to give tax advice, and I intend not to do that. So every time you hear something about taxes, IRS, anything like this, run it by your CPA first and get the expert advice on all those issues. So then you made all this money, your home doubled in value, and you're thinking about selling it and maybe buying a rental or investment property somewhere else where you get a better return, you like the area better, and then you're wondering, oh my God, I have to pay taxes on all those gains because it's capital gains. The great thing about investment properties is you can do something that's called the 1031 tax exchange. You can actually defer your property base over to the next property and not pay any money on the gains you have and the depreciation you took, which I explained earlier, if you buy a house of the same and equal value. And again, there are some restrictions and rules. There's timelines you have to stick with, and please run it by your CPA first. And I do have a video out there regarding 1031 tax exchanges and reverse 1031 tax exchanges. You might want to check that out as well. So to sum it up real quick, real estate investments are solid and very lucrative if done right. Financing might be a little trickier. Managing your investment is maybe a little bit more difficult, or you have to hire people to do that. But if you're buying the right property in the right area with proper appreciation on top of your rent income, I think it's a great way to build wealth. And it's perfect if you're thinking more long-term and you want to diversify your portfolio a little bit, get away from those crazy up and down swings in the stock market, for example. So if you have any more questions regarding buying investment properties here in California, hit me up. My name is Jürgen Herzog. You can either reach me or my business partner with any questions you might have regarding real estate. Until then, goodbye.